The ironclad rule of nature is that you get what you deserve. Imagine you could acquire a business simply by conversing with its operator for 30 minutes. No financial reports, no technical charts, no market data. What would you ask, and more importantly, what would you trust to make your decision? In an era where people mistakenly believe that investing is the art of faster clicks and smarter algorithms, this book, Chairman, Lead Investor, doesn't offer a magic formula for wealth. It does something far more dangerous. It demands that you pause and think. And that's precisely why it's inconvenient, addictive, and not for those seeking comfort. Munger doesn't offer advice, he hurls paradoxes. He doesn't copy rules, he interrogates fundamental beliefs. In a world of investing saturated with noise and preconceptions, his uncomfortably sharp clarity is what makes his ideas as vital as a flashlight in a room full of distorted mirrors. This book doesn't ask you to agree or concur, but if you're brave enough to be challenged and humble enough to re-examine yourself, it's highly likely you'll never view investing or your decision-making process the same way again. Chapter 1: The Fundamentals of Graham's Value Investing System. I never believed that investing was an art for geniuses. I saw it as a survival skill, much like learning to survive in a jungle, not through innate intelligence, but by clearly understanding where you stand, what you face, and when to retreat. That's why I followed Benjamin Graham's path. He not only taught me how to read a balance sheet, but also something far more crucial. When the market descends into madness, the one who stands still is the victor. I began my investment journey with simple questions. Why do people invest? How do you avoid losing money? What makes a good decision? And then, as if the universe had conspired, I encountered Graham's philosophy. It was unlike anything I'd seen on Wall Street, where everyone seemed to be engaged in educated gambling. Graham made me stop. He said, "An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative." It sounds simple, but to live by that philosophy amidst a chaotic market, you need what I call an iron will, something few possess and no one teaches in school. Graham was like a strict yet sincere father. He didn't romanticize the dream of getting rich. He forced you to look directly at the essence. He taught me that a company's intrinsic value isn't what's reflected on the ticker tape. It's an estimable number based on the future cash flow the business can generate, discounted back to the present at a reasonable interest rate. If the market price is significantly lower than that intrinsic value, you have an opportunity. If not, turn away. I once asked, what if I don't understand the company? Graham smiled, put it in the too hard pile. You don't have to invest in everything. You just need to wait for clear opportunities like a perfect pitch and swing when the time is right. That's what I learned from Warren Buffett, with whom I was fortunate to partner. He had a bucket with 3 labels: yes, no, and too hard. Most opportunities fell into no or too hard. Only a few landed in yes, but those were often magnificent opportunities. Our philosophy is not to invest frequently, but to invest correctly. I've seen many novice investors enter the market as if stepping into a casino. They get swept away by the rhythm, the cheers, the charts. They forget the most important thing. Behind every stock ticker is a real business, with real people, real machinery, and real money flowing in or out. One of Graham's vital principles is the margin of safety. Imagine you're building a bridge. If the maximum load capacity is 10 tons, you design it to withstand 30 tons, not because you're scared, but because you're smart. It's the same in investing. Buy when the price is sufficiently below its intrinsic value, so that even if you're slightly wrong, you still survive. I've seen too many perish for lack of a margin of safety. They bought stocks based on news, rumors, or technical analyses that smelled of rationality but were hollow at their core. They walked as if they could never stumble, and when they fell, they couldn't get back up. I don't deny the importance of analytical skills, but if I had to choose between someone who understands finance extremely well but is easily swayed by emotion, and someone with average analytical skills but ironclad discipline, I'd bet on the latter. Because the market is where emotions are amplified. Greed, fear, euphoria, despair, all playing out hourly, minutely. The survivor isn't the one who spots the best opportunity, but the one who rejects 99% of what's unnecessary. Therefore, I always start by asking, is this company easy to understand? Does it have a clear business model? Does it have a sustainable competitive advantage? Does it have trustworthy leadership? I don't need it to grow like a rocket. I just need it to be a slow, steady, resilient money printing machine that isn't easily replaced. Someone once asked me, "Don't you think you're too conservative?" I just smiled. I don't come to the market to be an innovator. I come to survive and accumulate. Real wealth doesn't come from reckless gambles, but from avoiding serious mistakes for 30 years. To invest effectively, you must be willing to wait, and waiting isn't a passive state. It's a very active, very difficult form of action. I've sat still for years, not making any new investments. Not because I lacked money, but because I couldn't find a worthwhile opportunity. People often think investing is a relentless series of actions. They see cash and imagine letting it sit is wasteful. But I'm different. I think like a marksman. If the target isn't clear, I don't pull the trigger. I'd rather be criticized for being slow than face the consequences of a hasty decision. Another crucial part of my philosophy is learning to think contrarian. If the majority of people are doing something, I immediately become suspicious. Not because I'm contrary, but because I know herd mentality often leads to disaster. People tend to buy when prices rise and sell when they fall. I do the opposite. I buy when there's blood on the streets and sell when everyone's partying on the trading floor. I was once asked, "How do you know when it's rock bottom?" I replied, "I don't need to know. I only need to know when the price is far too low compared to its true value, and then I buy. I don't need to catch the absolute bottom. I just need a sufficiently large gap between price and value so that errors don't kill me." In my early years, I was engrossed in calculating every detailed metric, every cash flow, every ratio. But over time, I simplified everything. I learned to look at the bigger picture. Is this an understandable, honest, capable business that the market is mispricing? If the answer is yes, I don't need more data. I prefer businesses like Coca-Cola, Costco, where everything is as clear as day. You don't need to be a financial expert to see how well they're operating. These types of businesses have a huge advantage. They're less dependent on genius management because their systems are robust, stable, and difficult to replicate. In the investing world, people often get caught up in chasing alpha outperforming the market. I look for negative beta, meaning the ability to not die when the market goes crazy. Survival is victory, because if you preserve your capital through multiple cycles, profits will naturally follow. Compound interest needs two things: time and not losing capital. Good investment decisions never come from a state of mental disorder. When you're angry, euphoric, panicked, or competitive, that's when you're most likely to make mistakes, so I often let a decision sleep on it. Only if it still seems reasonable the next morning do I act. I've missed many opportunities due to that caution, but I've never regretted it. Missing out is part of the game. You don't need to hit every shot, you just need to avoid destructive mistakes. People lose because of serious errors, not because of a lack of opportunities. That's why I don't chase trends. When the dot-com bubble burst, I stayed out. When the real estate market overheated, I stayed out. I was called old-fashioned, outdated, but I didn't care. I don't invest for applause, I invest for freedom. Freedom from the fear of losing money. Freedom from being a slave to the market. Is there a secret to success? I don't believe in secrets, I believe in discipline. I believe in understanding my own limitations. And I believe in repeating the right things for a long enough time. I also never forget that I can be wrong. That's part of a survival strategy. I always assume I'm wrong and only act when the margin of error still allows me to survive. This isn't a lack of confidence, it's a self-preservation strategy in an uncertain world. Graham once said, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine." I live by that quote. I don't seek consensus, I seek the true weight of a business. And I'm willing to wait until the market sees it too. There's another path, one that doesn't require noise, risk, or recklessness. It just requires you to have enough patience, rationality, and humility to accept that you don't need to do everything, just do a few things right, truly right. And that's how I've lived, invested, and navigated 4 decades without being swallowed by the market. Chapter 2: Principles of Graham's Value Investing System. I once thought that investing only required a few mathematical formulas and financial reports. But then I realized that, like any long-term game, investing isn't just a skill. It's a philosophy of life, one that demands principles. And without principles, you'll always be led by the market, like a hound chasing a whistle, never truly knowing where it's going. Graham provided these principles as a compass to navigate the chaotic world of investing. To me, Each principle is like an arrow on that compass, keeping me from getting lost amidst the frenzy of Wall Street. The first principle is to distinguish between investing and speculation. Sounds simple, but try asking 10 people buying stocks in the market. Perhaps 7 don't truly know if they're investing or just betting that the price will go up. Graham said, "If you're not sure you're investing, then you're probably speculating." I love that subtle sarcasm. It jolts people awake. I've seen speculators make a fortune in a single season. They'd boast strategies, share tips, open classes to teach wealth building. But then, with just one market reversal, they'd all vanish like soap bubbles. True investing isn't so glamorous. It's slow, boring, sometimes making you doubt yourself, but it's resilient. It's the kind of endurance found in northern pine forests, standing still against wind and snow. The second principle: protect your capital first. Profit comes second. This principle has saved me from dozens of wrong decisions. I don't seek the largest returns, I seek to minimize risk. You might call that the mindset of a timid person. I call it the mindset of someone who understands what kills an investor fastest. You might earn 100% profit in 1 year, but if you lose 50% the next, you're back to square one. I learned to put myself in the worst-case scenario before signing on the dotted line. I always ask, if everything doesn't go as I expect, will I survive? If the answer is no, I step back, even if the opportunity seems attractive. Graham's third principle is to demand a margin of safety. I've talked about it, but I'll reiterate because everything starts here. The market is unforgiving of mistakes, and because you're human, you will err. The margin of safety is the only cushion between you and collapse. If a stock's price is 30–40% lower than its true value, and you've calculated carefully, that might be an opportunity. But if the price is only 5% lower, I call that a gamble. The fourth principle: the market is a manic-depressive neighbor. This is one of my favorite images from Graham. He said, "Imagine you have a neighbor named Mr. Market. Every day, he knocks on your door, offering to buy or sell shares of a company at wildly fluctuating prices, sometimes too high, sometimes too low, with no rhyme or reason. And you have the right to buy, sell, or simply ignore him. The magic is that you don't have to react to him every day. You just need to wait until he goes crazy in a way that benefits you. That's how the market is. You don't need to be good at predicting it. You just need to be good at controlling yourself in front of it." The fifth principle: value investing is investing in a business, not a stock. This sounds easy, but very few truly understand it. They see stock tickers, prices, charts, but they don't see the company behind them. I once asked a new investor, "What are you investing in?" He replied, "The baby ticker has a very strong breakout pattern." I shook my head. I wasn't asking about patterns, I was asking about the business. Graham taught me to see through the charts, through the reports, to a real company with real products, real cash flow, real people. Only when you understand the company as well as you understand yourself should you put your money into it. The final principle in Graham's system: discipline. Nothing can replace discipline. Not intelligence, not a network of contacts, not speed of reaction to news. All are meaningless if you lack the ability to consistently do the right thing, year after year. I'm not saying I'm perfect. I've made mistakes, been tempted, been swayed by promises of enormous profits. But what kept me grounded each time was returning to these principles. They're like guideposts along a road on a foggy night. I don't always see the destination, but I always know I'm not falling into an abyss. These principles remained mere theories until the market truly delivered a punch. That was in the early 80s when an investment I had pursued with full logic and data suddenly plummeted due to a government tax policy change. The intrinsic value was still there. The business was still performing well, but the stock price dropped like a stone. I sat there watching my investment lose value every day, asking myself if I was wrong or if this was just the market acting insane, like Mr. Market. I didn't sell because I understood the principles, and years later, that investment yielded greater returns than anything I had held before. That lesson didn't come from a classroom, but from the scars the market left. That's when I truly understood that principles aren't just theories. They are a blueprint for building a mindset, an inner strength. Without it, you're easily swept away by rumors, news, and speculative waves. And the worst part is, you don't even realize you're being swept away. Graham never taught me how to predict the market. He taught me how to react to it with unwavering conviction. When everyone around you is panicking, can you remain rational? When others are greedy, can you stand still? And when others are standing still, do you dare to move forward? That's where principles unleash their power not to win every game, but to never be carried away by someone else's game. I call that disciplined, independent thinking. Independent thinking helps you see the world through your own eyes. Discipline helps you not betray that vision when everyone else is looking in a different direction. There's an image I particularly love when talking about principle-based investing, that of a farmer. You can't make rice grow faster by yelling at it. You can't fertilize it every day hoping to accelerate the cycle. You need to sow in the dry season, nurture it through the rainy season, and harvest when the weather is favorable. Any impatience leads to crop failure. Investing is the same. Sometimes you have to wait, sometimes you have to stand still, sometimes you have to cut losses, and sometimes you have to admit you were wrong. But you must never abandon your principles, because principles are the only thing that keeps you from becoming a speculator masquerading as an investor. Do principles ever become obsolete? I say, only when human greed becomes obsolete, and I've never seen that happen. Greed is still there, like a shadow behind every rally. Fear is still there, like an echo beneath every crisis. And as long as greed and fear persist, principles remain your only shield. It might sound like a monk on Wall Street, and that's not far from the truth. Principle-based investing is a journey requiring mindfulness, like meditation. Not because it demands you separate yourself from life, but because you must learn not to let life control you. You must learn to say no to easy opportunities, no to rumors, no to promises of quick riches. It's precisely those no's that lead you to the most incredible opportunities. Because when you have principles, you become rare, and in the world of investing, what is rare is valuable. When I look back at my 30 years of investing, it's not the biggest deals that make me proud, but the times I did nothing at all, the times I kept cash in my pocket while the market was throwing a lavish party. The times I turned down a seemingly delicious opportunity because it was outside my circle of competence. It was in those moments that I clearly saw principles as the source of your freedom. Without principles, you are your own prisoner. Investing isn't a game of who's faster, who knows more, or who's bolder. It's a game of who understands themselves better, who waits more patiently, and who sticks to their principles longer. You might make mistakes many times. But if you always make mistakes within the framework of your principles, you still have a path to survival. But if you're right a few times purely by luck, without principles, sooner or later, the market will reclaim what it gave you. That's everything I learned from Graham, not just to invest better, but to live slower, clearer, and more sustainably in a world that constantly wants to rush you faster than yourself. Chapter 3, Universal Wisdom. I once thought that understanding came from books. Then I realized the world doesn't operate the way textbooks teach. It functions through intersecting systems, intertwined principles, and hidden rules beneath the surface. If you only look through a single lens, you'll always miss the most important things. And that's when I began to build my own system of universal wisdom. I call it a multi-disciplinary mental model. But don't let that complex name intimidate you. Its essence is very simple. I borrowed fundamental principles from many different fields: psychology, physics, biology, mathematics, economics, law, then strung them together like pearls to illuminate investment decisions. Because I believe the truth isn't just in accounting books, it's in how humans behave, how the world moves, and how beliefs form and collapse. Graham taught me the foundations of investing. But to expand beyond those limits, I had to step into a wider world. I studied physics to understand system feedback, psychology to recognize cognitive biases, biology to see natural selection in businesses. And I studied history, not to memorize dates, but to see that greed and fear are two engines that never stop running in human society. When I mentioned this on Wall Street, some people laughed. They thought I was an eccentric old man pondering extinct dinosaurs while the market was rallying. But then they started coming to me when the market crashed, because at that point, valuation formulas could no longer save them. They needed a broader framework of understanding to comprehend what was truly happening. Let me give you an example. You see a company growing well, revenue exceeding expectations, market share expanding, everything looks perfect. But if you don't understand the principle of regression to the mean, a simple statistical concept, you'll easily believe the upward trend will last forever, and you'll invest as if tomorrow will be as bright as today. Then, when the company starts to plateau, you're surprised, panic, and sell off. But if you have the mental model of regression to the mean, you'll know that nothing grows uniformly forever. You'll prepare your mindset earlier than the market. Universal wisdom allows me to look at a company the way a doctor looks at a patient, not just at lab results, but at the whole picture: lifestyle, genetics, reaction to the environment. It helps me detect abnormal signs before they become problems. For example, a company with an overly aggressive growth rate is often like someone who drinks too much caffeine. Sooner or later, complications will arise. I believe investors cannot just be financial experts, they must be thinkers. If you're not curious enough to step outside your own field, you'll always be trapped in mental pitfalls, thinking every problem can be solved with an Excel formula. In reality, many of the biggest investment mistakes come from things that Excel cannot measure, such as human motivation, cultural shifts, or social network effects. I studied psychology not to manipulate others, but to protect myself from the illusions within my own brain. I discovered that we are not as rational as we think. We are biased by confirmation bias. We are more obsessed with losses than rewards. We cling to the familiar, and we evaluate the future based on current emotions. If you don't identify these things, you will be their victim in every investment decision. I also studied law to understand power structures. Sometimes, the reason a company performs well doesn't come from its product, but from its ownership structure and legal position. Understanding the law helps me see who truly controls the game and who is merely a pawn. That's something financial reports will never tell you. I studied biology to understand natural selection. I saw that the market is no different from an ecosystem. Weak companies will be eliminated. Well-adapted companies will survive. And sometimes a small mutation, a new technology, a change in customer behavior can lead to mass extinction, just as dinosaurs disappeared not because they were weak, but because they couldn't adapt quickly enough to climate change. And I studied history so as not to be surprised by repetition. People think every crisis is new, but if you read enough, you'll see old mistakes simply in new clothes. The Dutch tulip bubble, the dot-com frenzy, the collapse of Lehman Brothers, all are manifestations of one thing: humans always thinking, this time is different. I walked into an investment meeting where people were discussing a soaring tech stock. Everyone agreed that the company was the future of the industry, that its business model was irreplaceable, that anyone who didn't get in now would miss the train. I sat still, observing, not because I didn't understand, but because I had heard these exact phrases too many times, from dot-com darlings to various hyped companies, all of which later vanished from the financial map. I said nothing, because sometimes wisdom isn't in what you say, but in not getting swept away by the hype. Universal wisdom doesn't help you predict every market fluctuation precisely. It helps you not be destroyed by things others don't see coming. It's like having an extra radar. When the market is calm, you still hear distant thunder. Not to panic, but to prepare. I believe in people with perceptual acuity, the ability to see through the surface of an industry. Such people don't just analyze financial reports, they also sense crowd psychology, understand the impact of a legal decision, and anticipate consumer cultural trends. They are like musicians who can play many instruments, not to show off, but to know when to play what and when to be silent. What is the true competitive advantage in modern investing? I wouldn't say information, nor trading speed. I would say integration capability. The person who can integrate multiple mental models from different fields is the person who can see what others overlook. And when you see what others don't, you have the opportunity to do what others cannot. Someone once told me, "But I don't have time to learn as many things as you do." I replied, "You don't need to learn deeply, you just need to learn enough to have the right mental model. You don't need to become a physicist to understand chain reactions, nor a psychologist to identify cognitive biases. Just enough to ask a good question, enough to be skeptical of what the surface presents. That's what I do every day. I read widely, not to become a scholar, but to become a survivor. I read about war to understand strategy, about biology to understand competition, about mythology to understand human behavior, about probability mathematics to understand risk. To me, each field is a flashlight, and I need all of them to illuminate the investment picture I'm looking at. The world isn't compartmentalized. A good investment decision doesn't come from an excellent analytical spreadsheet, but from a series of observations across disciplines, across time, across perspectives. Investing isn't precise mathematics. It's a game of if and could be. And universal wisdom helps you live in that fog. You might think I idealize everything, that investing is about money, not philosophy, but I believe the opposite. Precisely because investing is about money, what sustains you, what determines your freedom, it requires more philosophy than any other field. If you enter the market solely with the goal of getting rich, you'll quickly get caught in a blind race. Only when you enter with a strong value system and a sound thinking framework will you be strong enough to weather storms without being knocked down. If you ask me where to start, I'd say start with the things others don't bother to learn: behavioral psychology, the history of financial bubbles, evolutionary biology, competition law, and even skeptical philosophy. You don't need to be an expert in all of them, but become someone who sees connections and always ask, what mental model is at play here that I haven't seen? Graham gave me principles, but it was universal wisdom that gave me the eyes to see beyond the books. I am not a prophet. I am simply someone who constantly tries to see the picture broadly enough so that when opportunity arises or danger appears, I am not caught by surprise. That's how I've invested, and that's how I've lived, not with certainty, but with a system flexible enough to face uncertainty. And in this world, where everything is always changing, that's a rare advantage you can keep for yourself. Chapter 4: The Psychology of Human Judgment Errors. I once thought mistakes stemmed from a lack of information. Then I met plenty of people with an abundance of information who still made terrible decisions. I used to believe logic was the guiding compass until I saw an entire market swayed by a story that wasn't true. And I began to understand, we don't lose due to ignorance, but because our psychological structure has too many blind alleys. These dead ends don't appear as warning signs, but as attractive, familiar, easy shortcuts until you realize you're in the wrong place. That's why I've spent a quarter of my life poring over behavioral psychology, not to manipulate the market, but to protect myself from my own mind. I understand that in investing, the greatest enemy isn't out there, but between your own ears. Identifying biases, the systematic cognitive distortions the human brain suffers from. For example, confirmation bias. Once you believe something, you'll only seek information that reinforces that belief. You'll overlook contradictory data, even dismiss it simply because it makes you uncomfortable. I've seen this happen even to seasoned investors. They fall in love with a stock and then become blind to every warning sign. Then there's loss aversion bias. When you're so afraid of making a mistake that you don't dare to act, or worse, you hold onto a losing investment indefinitely just to avoid the feeling of admitting you were wrong. I've seen people watch their assets evaporate by half just because of the phrase, "Wait a bit, maybe it will come back." Do you remember herd mentality? That's when people do something simply because they see others doing it. Crowds piled into Bitcoin in 2017, the dot-com bubble in 1999, real estate in 2006. Everyone believed this time is different. I learned that when you hear that phrase, get up and walk away. Most of us are driven more by an aversion to loss than a desire for profit. This means losing $1 hurts us twice as much as the joy of gaining $1. This leads to irrational behavior, cutting profits early out of fear of losing them, holding onto losses too long because we don't want to admit fault. I once made that mistake and paid the price in missed opportunities. Anchoring bias is also a dangerous trap. You see stock ABC once peaked at $100 and is now at $60. You think it's cheap because your mind is anchored by the old number, but the actual value of the business might have changed. The anchor is no longer valid, but you're still tethered to it without realizing. I also observed the effect of framing. How information is presented affects how we evaluate the same investment. If you talk about an 80% success rate, people get excited. If you talk about a 20% failure rate, they're hesitant, even though it's the same thing. This is something the media exploits fully, and it's something I had to train myself not to be misled by. Overconfidence bias is one of the biggest perils on Wall Street. People think they know more than they actually do. They imagine that a few successes are due to talent, not luck. I call that the illusion of control, and it causes many big players to vanish after just one mistake. I've witnessed fund managers rise like fireworks and fall with similar speed because they thought they were exceptional, capable of overcoming every cycle. I never thought that way. I always assume I could be wrong. And I built my entire investment system around one question: if I'm wrong, can I still survive? The combination of psychological biases doesn't just distort individual judgment, It creates collective bubbles. A bubble is when a personal error is replicated millions of times. Prices no longer reflect value but emotions. And at that point, you're no longer investing. You're playing a collective psychological game where the last person holding the hot potato gets burned. That's why I always start by examining myself. I write down the biases I'm prone to. I try to create an investment process that makes me as immune to emotions as possible. And I established a cross-checking system where important decisions must pass a series of paradoxical questions. If someone I disliked proposed this deal, would I still like it? If the price drops 20% after I buy, will I be rational enough to hold? The smarter people are, the more susceptible they are to the trap of overconfidence. It's often highly educated individuals with good grades and sharp minds who are the biggest losers in the market. Because they not only misjudge the situation, but they also refuse to believe they can be wrong. So, they double down on one mistake, then hold onto losses after a second, and by the third, they're wiped out. Investing isn't an intellectual sport, it's a soft martial art. It doesn't require you to be good at attacking, but rather at dodging blows. The most dangerous punches don't come from the market, but from the blindness driven by ego. I learned to question my emotions. Whenever I feel overly euphoric, I stop. Whenever I feel too afraid, I write in my journal. I don't allow myself to make decisions in a state of mental imbalance, because I know mistakes don't come from a lack of facts, but from an incorrect emotional state at the wrong time. Consider our dependence on short-term rewards, something we inherited from our hunter-gatherer ancestors. Our brains release dopamine whenever we make a profit, and we get addicted to that feeling, like gamblers pulling slot machine levers. We don't invest to get rich, but to feel right. And because of that, we easily rush into decisions just to seek validation. Once, a young investor told me he had doubled his assets in 3 months. I asked, "How did you prepare yourself mentally for losing half of that in a week?" He laughed, "That can't happen so quickly." I didn't reply. A few months later, he returned, no longer with assets, but only with the question, "Why did that happen to me?" I told him, "Because you're human and humans make mistakes." I don't tell that story to lecture anyone. I tell it to remind myself every day that if I don't continuously reassess my thinking, I too could be a victim. I too could be swept away by waves of euphoria, blinded by a string of consecutive gains. I don't believe in any system that doesn't make room for humility, because pride is where the greatest failures begin. Therefore, I always reserve a part of my system for the unpredictable. I don't try to predict what the market will do. I only prepare for what I will do when the market does something I don't like. I always maintain discipline, not because I'm rigid, but because I know that in a heightened emotional state, I am no longer myself. I use a checklist for every investment decision, like a pilot checking a plane before takeoff. Not because I doubt my intuition, but because I doubt the version of myself that is euphoric or under time pressure. The checklist helps me retain the sober version, the version I trust the most. I also learned to take a step back, to view the market as a game I can choose not to play. I don't always have to buy, I don't always have to react. Sometimes, the wisest decision is to stand still. People fear missing opportunities. I fear rushing into things I don't understand. Mistakes are not the enemy, hiding mistakes is. If you dare to look directly at why you were wrong, you can correct it. If you blame the market, circumstances, or others, you will repeat the exact same mistake in a new form. The market is a machine that transfers money from the impatient to the patient. And I believe the market is also a machine that transfers money from those who don't understand themselves to those who do. If you don't master your psychology, you will forever be a pawn on the chessboard of emotions, no matter how much data you have. I don't claim to be immune to bias. I simply build a system to identify it as early as possible. And I live with the assumption that if I don't re-examine my thoughts today, it's very likely that tomorrow I will make an irreversible mistake. Because in investing, as in life, those who don't learn from psychological errors are doomed to repeat them forever. Chapter 5: The Right Human Element for Successful Investing. The day I entered the stock market, I carried 3 things: a curious mind, a cautious heart, and a book by Graham tucked into my jacket pocket. I thought, like many others, that merely understanding numbers, memorizing ratios, and following logic would lead to success. But then I witnessed individuals smarter than me, with more education than me, collapse during tumultuous market seasons. They had everything except the right stuff. Investing isn't just an analytical discipline, it's a lifelong psychological test. And the winner isn't the best calculator, but the one who survives the longest with a sound value system, what I call the right stuff. The first quality I call independent thinking, to the point of being considered eccentric. It's the ability to step out of the crowd, not just to be contrarian, but to see with your own eyes. They don't need market validation. They don't need others' agreement. They are confident enough to say no when everyone else says yes, and they find it unremarkable to buy only 3 stocks all year while others churn their portfolios like changing clothes. I once met a man like that. He never watched financial news, never read technical analysis. He just sat and read annual reports and shareholder letters. Year after year, he held his portfolio steady, as if nothing was worth bothering about. And the result? He was 10 times wealthier than those blindly chasing trends because he didn't make money from speed, he made money from conviction. The second quality, iron discipline. Coldly efficient, like someone operating a nuclear power plant, you must not let emotions interfere with decisions. Don't think you're invincible because of 3 profitable sessions. Don't panic sell because of a week of losses. Discipline isn't something you're born with. It's something you forge every day with every decision, every painful no to a seemingly lucrative but principle-violating opportunity. The third quality, lifelong learning without information overload. You need to constantly expand your understanding, but also know how to discard the junk. I see many people who read a lot, but their knowledge is like a tangled mess of wires, short-circuiting everywhere. Those with the right stuff know how to filter. They don't need to know everything. They just need to know the right things that are applicable and discard the rest. The fourth quality, humility, to the extent of constantly assuming you might be wrong. People often say confidence is the key to success. I think humility is the door to survival. You must never believe you fully understand the market, never believe you're immune to bias. You must always ask, what if I'm wrong? And build your portfolio in a way that allows you to survive even if you are. One person invested in only one stock because he understood it like the back of his hand. That year, the stock encountered legal issues. His account evaporated by 70% and he vanished from the market. I don't need to say more, the lesson tells itself. The fifth quality, patience, to the point of being called lazy. The market is where the impatient pay the patient. I once bought nothing for 18 months. People asked, "Don't you see any opportunities?" I replied, "I see many, but none are safe." And then, when the crisis hit, I bought more stocks in 3 months than in the previous 3 years combined, at prices as cheap as during a financial crisis. The right stuff isn't found in academic degrees, nor in the speed of reading reports. It's in a person's character. You can teach someone how to value a business, but you can't teach them the ability to wait. You can show them a discounted cash flow model, but you can't teach them the courage to stand still when the market screams in panic. I once tried working with a very intelligent young man. He was good at math, quick-witted, reacted well to news, but he couldn't sit still. Every day he had to do something: buy, sell, analyze, search. I told him, investing isn't a speed game, it's a test of delay. He didn't listen. 6 months later, his portfolio was like a never-ending storm, ultimately a dead end. There's a simple truth few are patient enough to accept in investing. Most of the time, you'll do nothing. You'll wait. Wait for opportunities, wait for reasonable prices, wait for the market to go crazy and then sober up. The hard part is waiting without going insane, waiting without doubting yourself, waiting without asking if you're wasting your life. The most essential quality of all, what truly makes the right stuff, is inner tranquility. It's when you can sit alone in silence, not urged to do anything, not pulled by emotions, not pressured by anyone else's expectations. If you can maintain that serenity, you can invest and live consciously. I once stood between 2 choices. One is to pursue a deal that everyone affirmed would be a sure thing. Paper profits could reach 200% in just 6 months. The other was to pass on it. Because I felt something wasn't right, a small detail in the audit report, an unusual change in management. I chose to stay out. 6 months later, the company was embroiled in a serious financial scandal, its stock plummeting 90%. At that moment, I didn't feel smart, I just felt lucky. But that luck came from being alert enough not to get swept away. The right stuff isn't the ability to always be right. It's the ability not to lose too badly when you're wrong and to survive long enough so that when you are right, you capture the entire cycle. That's why I always build my portfolio on the principle of not dying from mistakes. Because I know I will make mistakes. Everyone does. But those with a strong defensive system still have a chance to recover from errors. Those without, just one big mistake can be the end. You might call that the art of defense. I call it the instinct for survival. And in the world of investing, survival is the foundation of everything else that can be built upon it. Part of the right stuff also lies in saying no to easy attractions. I've seen tempting deals, accompanied by promises from friends, colleagues, even the media. I felt as if everyone was pressuring you into a behavior. If you don't join, you're foolish. If you join late, you'll regret it. And if you stay out, you'll be considered unfashionable. But I didn't care. I don't live to be fashionable. I live to have no regrets. And the biggest regret in investing isn't missing an opportunity, but knowing you're wrong yet stubbornly pushing forward. Someone with the right stuff knows that no opportunity is the last. The market always opens new doors, but you only have one key, your own discipline. Lose that, and you have nothing left to protect yourself. I've met many intelligent people. They can read financial reports like short stories. They can recall every line of data, yet they cannot say no to a risky deal simply because they fear being left behind. They don't lack information, they lack a backbone. And the right stuff is that backbone. It's the ability not to buckle under a screaming market. It's the ability to stick to principles, even when it makes you temporarily look like a fool. It's the ability to play the long game, not losing sight of the overall strategy for a few small victories. I've been wrong many times, but I survived. And after each mistake, I wrote down the reasons, dissected my emotions, and reviewed my decision-making process. I didn't blame, didn't make excuses, didn't talk about prices, I just learned. Learned to make fewer mistakes next time and to be right in a more profound way. The right stuff isn't something anyone can give you. No teacher can teach it, no book can show it. You can only find it through every financial storm, every sleepless night over a wrong purchase, every time you sit watching your portfolio bleed red yet maintain inner calm. I can't tell you how to always be right, but I can show you how not to die from being wrong. And that, I believe, is the most important thing an investor can learn, because ultimately, it's not the smartest who win, but the ones who don't give up, the ones with principles, the ones with the right stuff. The stuff that helps them pass from one cycle to the next and still stand firm when others have vanished from the game board. Chapter 6: 7 Variables in Graham's Value Investing System. For years, I thought investing only needed a few simple formulas. I learned financial analysis, business valuation, portfolio management, all the things taught in books. But then, after many more years, I came full circle back to a simple truth. Every sound investment decision revolves around a few fundamental variables, not too many, just 7. But you must understand them as intimately as you understand your own character. Graham called them the 7 variables, the core variables of his value investing system. But to me, they aren't lifeless variables in an equation. They are 7 heartbeats, 7 types of reactions, 7 layers of protection before you commit your money to any business. The first variable, current earnings, simple, yet surprisingly underestimated. People are captivated by growth prospects, by visions of expansion, by distant promises. But I ask, how much money is this company making right now? Not next year, not 10 years from now, but currently. Where does that cash flow come from? Is it sustainable? Is it real? I don't believe in speculative models. I need to know a business can sustain itself and me in this present reality. I've seen companies that lived on expectation, not profit. They evaporated like smoke after a policy change, and the investors who followed them rarely ever came back. The second variable, future growth prospects. This is where psychology begins to intrude because humans are creatures obsessed with the future. We're easily swayed by stories. If everything goes right, profits will quintuple. I don't deny the importance of growth, but I always ask, where does this growth come from? Is it repeatable? Are there competitive advantages that can sustain this momentum? I divide growth into 2 types. Real growth, which comes from product innovation, market expansion, and process optimization, and illusory growth, inflated by marketing, asset revaluation, or leveraged debt. Do you know which type usually attracts more investors? The illusory kind, of course, because it's easier to spin into a beautiful story. But you don't invest in stories, you invest in cash flow. The third variable, dividend yield. Young people often don't care about dividends. They prefer capital appreciation. They think, Why accept a few percent per year when I can 10x my account? I understand that. I once thought that way. Until I saw that discipline in paying dividends is precisely the sign of a business that truly cares about its shareholders and has the internal strength to maintain it. Dividends show me that the company has real profits and is willing to share. It's also a cushion during market downturns. I don't need to sell stocks to have cash flow. I sit there and receive money year after year. It's not romantic, but it's incredibly resilient. The fourth variable, price-to-earnings ratio, PE, a small number but often the most misunderstood. People think a low PE means a cheap stock, but that's not always true. A low PE can be a sign that the market is signaling something, the business is in trouble, the model is outdated, management lacks transparency. I don't buy something just because it's cheap. I buy when it's cheap relative to its true value. Likewise, a high PE isn't always bad. If a company has high growth, strong competitive advantages, and superior profitability, then a high PE can be justified. But you must check whether it's high due to quality or inflated expectations. I've seen stocks with a PE of 80 turn negative after a single bad earnings report. The market is unforgiving of fragile dreams. The fifth variable, net asset value. This is one of Graham's and my favorite variables. It helps you measure what would remain for shareholders if you liquidated the company today, sold all assets, paid off all debts. Sometimes the market prices a company below its book value. If that company isn't bleeding heavily or disintegrating, you might be looking at a rare opportunity. I once bought a company whose market value was lower than the cash it held in its bank account. Yes, their cash alone was more than the stock's market price. The rest, factories, equipment, personnel, brand, was practically given away for free. Of course, the question isn't, is it cheap? But why is it so cheap? Sometimes the market is right when it punishes a business, but sometimes it's just in a panic. I don't buy because it's cheap. I buy because I understand what I'm buying. Understand it so thoroughly that if the market closed for 3 years, I still wouldn't worry. The sixth variable, financial position and debt structure. This variable is often overlooked until everything collapses. I always check a business's debt level the way a doctor checks a patient's pulse before surgery. A company with growing revenue but high debt is like a person who looks healthy on the outside but has clogged arteries on the inside. All it takes is a single headwind, rising interest rates, tightening credit, and the entire system collapses. I've seen businesses that looked beautiful on paper, with high profits, but then one day, unable to secure new financing, they started selling assets, selling brands, selling even themselves. I never invest in any business whose ability to pay debt depends on growth expectations. I want them to be able to survive even if profits are zero for a few years. Only those who can weather the winter with enough provisions are worth accompanying. And the seventh variable is also the most subtle, quality of management. This is something without measurable numbers, without charts, without quantitative indicators, yet it holds decisive weight. I've turned down dozens of attractive businesses simply because I didn't trust the leadership, and I've stuck with mediocre companies simply because I trusted the people steering them. Quality of management isn't just about ethics. It's about competence, transparency, honesty in reporting, the courage to take responsibility when wrong, and consistency between words and actions. I read every shareholder letter. I observe how they react in a crisis. I research their work history at previous companies. I don't need them to be perfect. I just need them to be people I'm willing to entrust my money to and sleep soundly every night. I know what I'm sharing isn't appealing to a generation that prefers chasing AI valuation models, automated charts, and investment robots. But those who have lived through a real financial cycle will understand. Ultimately, what keeps you alive and moving forward isn't technology, but mindset. And these variables, these 7 seemingly simple things, are the framework of a steadfast mindset. I don't use these 7 variables as a scorecard. I use them as a filter. I don't need every variable to be absolute. But if 3 to 4 variables are outstanding and none are flashing red warnings, I start to pay attention. Then I dig deeper, layer by layer, like an archaeological hunter, unhurried, not led by emotion. Sometimes I reject an opportunity because of a small line in the financial report's footnotes. Sometimes I choose to hold on just because I see the CEO still taking compensation in stock, not cash. These small details, to me, are not secondary. They are signals, and signals are worth more than promises. Value investing isn't about creating a perfect valuation model. It's about understanding the business well enough to know what you're buying, why you're buying it, and what you'll do if things don't go as expected. Graham's 7 variables, if rightly understood, will give you the tools to answer those 3 questions firmly. And if you know how to use them without haste, without being overly clever, you'll have more than one chance to get rich. You'll have the chance to get rich without worry, without regret, and without sacrificing yourself. Chapter 7: The Right Elements in a Business. Throughout my career, I've realized one crucial thing: you don't invest in stocks, you invest in businesses. The ticker symbol flashing on the screen is merely a facade. Inside are people, strategies, culture, and complex systems that don't appear in financial reports. If you don't understand the business, you're gambling, not investing. And understanding a business means recognizing what constitutes the right stuff within its internal structure. Not every company is born worthy of long-term holding. There are attractive names, trendy products, impressive growth, but inside they're hollow, like a balloon inflated with expectation. So what kind of business truly has the right stuff? First, I look at the business model. It must be simple, easy to understand, easy to predict. If I need 3 hours and 4 slides to understand how this company makes money, I stop. I don't need complexity to see intelligence. I need clarity to see survivability. Remember this: a business can be complex in its operations, but its money-making model must be simple enough for a child to grasp. Coca-Cola sells soda. Costco sells goods with low margins to retain loyal customers. Apple creates a closed ecosystem to keep users as long as possible. The simpler, the easier to control, the more trustworthy. Next, I look for a sustainable competitive advantage, also known as a moat. Not every profitable business has a moat. You must clearly differentiate this. Profits can come from a season, a trend, a policy. A moat is the ability to sustain those profits over time, through competition, through crises. A moat can come from a brand like Apple, from low cost like Walmart, from network effects like Visa, from user data like Google, from a distribution system like Amazon, or from control over resources like a monopoly mining company. You must identify what that moat is and ask yourself, if another company wanted to compete, how long would it take, how much money, and how many mistakes would it cost them to catch up? The third and often most underestimated factor: corporate culture. Culture isn't on the boardroom walls, it's in how employees react to risk, how leaders deal with failure, how the company treats customers when no one is watching. A company with a strong culture will see you through a crisis. A company with just slogans will break as soon as cash flow falters. I once saw 2 companies in the same industry, same size, same market conditions. One company weathered the 2008 crisis and emerged stronger. The other went bankrupt in less than 6 months. The difference? The first company had a team willing to share the burden, leadership took pay cuts first, no one was laid off. The second company laid off many employees at the first sign of loss and lost customer trust. The result: one recovered, one vanished. I also look at the ability to generate free cash flow, not accounting profit, not revenue, not EPS, but the real cash left after the company has paid all operating costs and maintenance investments. If a business consistently generates cash flow, even during slow growth periods, that's a sign of a sustainable machine. But cash flow isn't enough. I also need to know what they do with that cash flow. Do they pay dividends? Do they buy back shares? Do they reinvest in effective projects? Or are they using it for blind expansion, inflating numbers, or chasing prestige? How a business uses its money reflects the true values of its leadership. I call it capital allocation skill, and only a small fraction of businesses possess it. Most, even good businesses, use capital as if it were endless. They acquire other companies, expand into unrelated fields, hire expensive marketing teams to buy growth, and then, when cash flow stalls, they panic, cut back, sell off, and lose their original position. One of my favorite questions when researching a business is, if the CEO disappeared tomorrow, would the company still operate well? Because if the company's system relies too heavily on one individual, no matter how brilliant they are, that's not a sustainable model. A sound business is one that can continue to print money without anyone needing to shout orders every day. I don't look for businesses with superheroes. I look for businesses with effective self-operating systems. This doesn't just come from technology or processes, but also from a stable and transparent organizational culture where all levels clearly understand their mission, roles, and core values. And I always check for consistency between words and actions. If the company says they care about long-term shareholders, I'll see if they dilute shares. If they declare a commitment to the environment, I'll examine their ESG report to see what they actually do. If they promise to invest in core technology, I'll look at their R&D expenses and the profitability ratio of new products. People can say anything in a meeting, but financial data and cash flow will tell the real story. I once followed a tech company highly lauded by the media. The CEO gave eloquent speeches, the product was attractive, the strategy groundbreaking. But I noticed a small thing. Each quarter, the number of outstanding shares slightly increased, silently diluting value. Marketing costs ballooned faster than revenue, while R&D remained unchanged. The board regularly sold shares quarterly. 3 years later, the company hadn't gone bankrupt, but shareholders had lost over 70% of their value. I wasn't surprised. And then there are companies on the other side. No one talks about them, they're not glamorous, but they grow steadily, don't take on debt, have stable dividends, buy back shares when prices are low, and leadership only speaks when truly necessary. 5 years later, they become pillars of the industry. Anyone who held their stock grew wealthy peacefully. A sound business is also one that knows how to say no to hasty growth. I like companies that refuse to expand until efficiency is guaranteed. I respect companies that close inefficient branches instead of continuing to inject capital just to save face. Because a business that knows how to cut off dead parts is a business that understands the most important thing. Long-term survival is more important than looking best in the short term. I once said, a good business is like a money-printing machine with a non-arrogant operator. But I'll add one more thing. A great business is a money-printing machine whose operator always prioritizes the long-term interests of shareholders. They don't try to manipulate stock prices for quarterly bonuses. They build to endure a lifetime. And that's why I like family businesses, companies where the founders still hold large stakes, still sit at the dinner table with their children and grandchildren, still view the company's stability as a legacy, not just a number. They don't need to prove themselves to Wall Street, they just need the company not to fail. And that motivates them to protect true value more than any outsourced CEO. Finally, I ask myself one question. If the market closed for 10 years, would I still be willing to own this business? If the answer is yes, then that's a business with the right stuff. But if I need hourly price updates to feel secure, then I'm not investing, I'm speculating. The right stuff in a business isn't a score. It's character, it's philosophy, it's the choices that business makes when no one is watching. You won't see it at an IPO. You won't perceive it through a few lines describing the industry. But if you listen carefully, dig deep into reports, ask the right questions, you'll see it. And when you see it, you should hold on to it. Because such businesses are rare, but when found, they will be the most valuable assets you've ever owned. At this point, we are not just closing a book. We have journeyed through a system of thought where investing is no longer dry mathematics, but a way of looking at the world, a way of self-reflection in the life and death decisions concerning money. It's about rationality and the limits of understanding. Charlie Munger doesn't teach us how to get rich quickly. He teaches us how not to slowly die in ignorance, gilded by the buzzword of growth. He doesn't teach us formulas, he reveals the essence. And that essence, whether we agree with it or haven't fully grasped it, forces us to rethink the very financial lifestyle we pursue. If you feel challenged, put in a position to question old beliefs, or even feel a bit uneasy after listening to this book, then perhaps you are on the right track. Because true knowledge doesn't lull the reader to sleep. It makes us uncomfortable, it shakes us, it reestablishes foundations. I know you may have come to this book simply wanting to understand value investing better. But if you leave with a deeper insight into yourself, into your decision-making process, and into the role of humility in a world full of misconceptions, then perhaps you have gained more than any PE ratio or valuation model could ever provide.